Right traders, welcome back to the channel. Here we have the higher time frame daily chart of the GBP USD time frame, right? So what we're going to be going over today is a topic that I think a lot of people are interested in seeing, and it is essentially how to choose higher time frame POIs, or how to choose how to choose POIs in general that are high probability, that have a higher success rate when it comes to following through with our trade and our analysis, essentially, right? So before we go and look at the live market, and before we go and chart up, essentially, I'm going to just dissect very quickly what I look for when it comes to a high probability POI. Now, when it comes to choosing a high probability POI, or like I like to call A plus POIs, there's essentially two categories that we're going to look at. When it comes to choosing POIs, we have two categories. The first category is our rules. The second category is our confluences. Right. So there is a very, very big difference between these two when it comes to rules and confluences. Rules are three things. We're going to be discussing three things that have to be there regardless of which market or time frame you are looking at. It's very important to understand that these things must always exist. And the three rules to a POI are quite simply the POI must break something. It has to break either a supply or demand zone, it has to break internal structure, or it has to break structure as a whole. It must break something. So we need to see a break of structure, or a BOS for short. The second thing fair value gaps must leave is an inefficiency or a fair value gap. A fair value gap is absolutely key, and we're going to go over why that is later on in the video. And the third thing we need to have is we need to have price respecting the PD arrays. What do I mean by that? Well, we want to be looking for bullish POIs in the discount, and we want to be looking for bearish POIs in the premium. So this video will dissect a couple of bearish POIs. So we're going to be looking for how a POI can be priced in the premium when we're looking for sales, right? So let's quickly go over our rules. So very simply, if we have price in a downtrend, we're going to see price creating new lows and higher lows, and we're going to have a break of structure like this. So this here represents our structural break to the downside over here. So this is our first rule, essentially. So we've seen price break something. The break is simply a structure, and more often than not, it is going to be a structure, right? So we're going to see price break structure just like this, right? So this high over here has successfully broken this low. That's the first thing we look for. Now, the second thing we look for is a fair value gap, and we're going to see price leave a fair value gap in and around this region over here. So this is the blue region over here. The blue region represents a fair value gap, and typically just above the fair value gap, we're going to have our POI just like this. So the POIs I always mark out in gray, and a POI represents an area where we want to look to sell from in this example, or buy from if we were looking at a bearish example. So a POI over here, just like this, a POI has to have three rules like we've discussed. It must break structure, check. It must leave a fair value gap, check. Now, what's the last thing it does, right? When we see price give a retracement, right, into the POI before reacting and heading lower, we need to understand the POI must be in the premium when we're looking for sales, right? So our structural high is up here and our structural low is down here. So we understand that our premium is above this 50% level. This 50% level represents the equilibrium in price, and it's very simply the midpoint between the swing low and the swing high. So these are three critical rules, essentially, not confluences. These are rules you need to determine a successful POI, right? A high probability POI that matches the rules. If you don't have one of these rules, the chances of your POI being successful and being A plus is much slimmer. So it's important to understand that. So with these rules being said, let's go to the chart, and we're going to be dissecting it from a rules-based perspective, but also from confluences. And a lot of the confluences we have boil down to one thing, essentially: liquidity. Inducement in particular, right? Inducement is a form of liquidity dropped just before POI. And now we're going to go over that now in the live charts, right? So what we see over here is we see price giving us an initial shift of structure to the downside just over here. So this local high, this local low over here was broken. Now, since then, we've had price delivering new lows in the market. So we had a break of structure just over here, and we had a break of structure just over here. So our first rule of a breaker structure has been ticked. So that's tick. Check number one, or rule number one has been accomplished. Now, if we look at rule number two, over here in price, what do we see? Our rule number two was a fair value gap. Now, our fair value gap, as you can see, is just in this region over here. So we have a fair value gap over here that I'm going to label with a blue box. And this fair value gap is an inefficiency in price, right? So if I zoom in even further, we see that the fair value gap was essentially left from this candle over here. So this is another rule to a POI. So we've had a break of structure, we've had a fair value gap. Now, what is the last rule we look at? Premium versus discount. Excellent. So we understand that we have a structural high up here and a structural low down here. So how do you use the Fibonacci tool? So the Fibonacci tool from an ICT perspective is used quite simply, in my opinion. It's just to swing the Fibonacci from the swing high down to the swing low. So you want to project it from the swing high down to the swing low. And now from here, we understand that we have a candle just over here that leaves an inefficiency in price. So this candle over here was the last candle that leaves an inefficiency in price. Now, it's important to understand that it doesn't have to be an up candle or a down candle or a wick or anything like that. It just needs to be the candle before the inefficiency, right? That's the only thing you need to know, because I have a lot of students asking me, oh, liquid effects, does it have to be the up candle? Does it have to be a wick? Does it have to be a range? It doesn't have to be anything, right? It literally has to be the candle prior to the inefficiency. You can even have your POI like this if you want, but I prefer, especially on GU on the higher time frames, I prefer to cover the last candle prior to the inefficiency. So we see a candle over here and we see an inefficiency over here. Price comes in, respects this zone over here, this POI, and it melts to the downside, right? So this is essential. Quickly get that right. So this is essentially how we determine our POI from a rules-based perspective. Now, when it comes to our confluences over here, what we're looking for is an inducement. So do you see the inducement in this chart? Well, the inducement is quite simply this high over here, this miniature high over here, this high over here. So a simple hack to determine whether it's an inducement is like this, right? If price breaks structure like this to the downside, so if we see price giving us a melt over here, and then continuing lower like this, what we're looking for is we're looking for a sweep of the liquidity that fills the inefficiency over here before heading lower. So to put it into practice for you in a second, this here is an inducement over here. So you want to have your POIs giving some sort of an inducement. So you want to see price giving a liquidity drop just like this. Now the reason why we want to see that is quite simply we understand that the liquidity is fuel for the market, right? So in order for us to fuel a down like this, what does price have to do? Price has to essentially think of liquidity as fuel for a vehicle, right? For the vehicle to travel long distances, right? As in going like this. So price has to travel long distances to go down like this. What does it have to do? Right? It has to follow our rules of a POI, but more importantly, we need to sweep liquidity, right? Buy side liquidity over here in this case, sorry, not sell side, buy side liquidity in this case, tapping an inefficiency before heading lower, right? So this is the fundamental principle to determining a higher time frame POI. That's an A plus POI, sorry. You want to have your rules and your confluences, right? The rules are more important than the confluences. I just want to reiterate that again. The three rules are very important, and the confluences all lie within the concept of liquidity and inducement. Very, very important to understand. We really hammer this into the students. I really hammer this into the liquid FX students as well. You must determine your POIs with these rules and back them up with confluences such as liquidity, right? So if you like this video, give it a like, give it a thumbs up, and I look forward to seeing all of you in the next one.